Hi, this is Rowland for Money and Markets TV. As you know, I'm a big proponent of exchange-traded funds. And one of the reasons why is that they relieve you of the challenge of deciding which individual stocks to buy out of the thousands available. Stock picking is a tough business. But another piece of the equation when building a portfolio is figuring out your weighting strategy. In other words, how much of your portfolio do you allocate to each stock or sector? Getting it right is crucial to your long-term success. To illustrate this point, I want to look at 8 different ETFs that hold U.S. large-cap stocks and show how their different weighting strategies can result in vastly different results. All 8 of these funds use the S&P 500 index as their benchmark, and generally, any ETF that calls itself large cap will have most of the same stocks as the S&P 500, but they combine these stocks in various ways. Take a look at this list of domestic large cap ETFs and their 3-year performance. There's a huge difference from the top to bottom, from an 18.6 return by the RIDEX S&P 500 Equal Weight Fund to minus 1.1% by the Wisdom Tree Large Cap Dividend ETF. That discrepancy is due to their respective weighting strategies. Let's take a little closer look at each one of these funds and its strategy. Starting from the bottom with DLN, it gives more weight to stocks that pay high, consistent dividends. But over the past 3 years, that hasn't worked out so well because the financial crisis forced many companies, particularly banks, to cut their dividends. Moving up the ladder to the Wisdom Tree Earnings 500, ticker symbol EPS, it allocates its money across large cap stocks according to their corporate earnings. That approach produced a 2.2% return over the past 3 years, nearly identical to the S&P 500's performance. The Spider S&P 500, ticker symbol SPY, is the de facto standard for these types of ETFs, and it produced similar results over the past 3 years. It uses the traditional approach of weighting the 500 stocks in an index by market capitalization. The 10 largest holdings have an 18.8% of the fund's allocation, while the 10 smallest ones occupy less than 0.2%. The PowerShares Dynamic Large Cap, ticker symbol PJF, uses an IntelliDex methodology to pick the stocks with the greatest potential for price appreciation. But apparently PowerShares is not satisfied with its 4% return over the past 3 years. Starting June 16th, they will change the ETF's benchmark index, ticker symbol, and investment strategy to make it look more like another one of PowerShares' offerings, the FTSE RAFI US 1000 portfolio. That fund earned more than 15% over the past 3 years, using a methodology based on the Research Affiliates Fundamental Index. PRF holds 1,000 stocks weighted by their book value, cash flow, sales, and dividends. The Revenue Shares Large Cap Fund, not surprisingly, bases its holdings on revenue. Companies that bring in more money get a larger allocation. The First Trust Large Cap Core AlphaDex ranks stocks according to criteria such as sales, growth, and cash flow. The higher ranked companies get a bigger weighting, and the lowest ranked 25% are not represented in the fund. And finally, the domestic large cap ETF with the best performance over the past 3 years was the RIDEX S&P 500 Equal Weight, ticker symbol RSP. It holds all 500 stocks in the benchmark index, but in equal allocations. From its performance, you might be tempted to think that this is the best strategy. That was true over the last 3 years, but it may not be true during the next 3. In the future, any one of these ETFs could become the top performer. It all depends on the market conditions and the approach that is best suited for those conditions. To determine which ETF is right for you, you need to decide what your goal is. If you want your portfolio to look like the overall market and you don't expect outperformance, then SPY is probably your best bet. If you want the potential to do better than the S&P 500, then you may want to look at one of the alternative weighting ETFs. And always remember to factor in risk. Some of these ETFs are much more volatile than the others. For Money and Markets TV, I'm Ron Rowland. Thank you for watching.